This podcast is brought to you by Knowledge Wharton.
Hello, and great to be here with everybody. Great to have what is going to be a phenomenal panel here today. And I'll start out with this mindset of long-term thinking and how it's starting to impact each one of you in terms of your companies. Arlene, I'll start with you.
Thank you, Dan. It's a pleasure to be here, and thank you to the conference board for the invitation. So at Moody's, we're a company that's been around for over 100 years. And so one could argue that we are adept at transitioning through many economic cycles throughout history. However, as Claire mentioned in her presentation, we do see this as more of a structural shift, particularly with the influence of technology and also an aspect of developed markets to some extent being mature, particularly in the context of our business. And so when we think about being future ready, it is also a transformation in regards to long-term thinking, but it's not just about the business for us. Prior to the role I have today, I ran the business for Europe, the Middle East, and Africa. And it was then that we started observing that not just shareholders, but stakeholders were particularly interested about alignment of values with the organizations that they do business with. And so in the context of that, we re-engineered our corporate social responsibility strategy to be one that was more global in approach, allowed for us to actually introduce innovation and sort of creative thinking within the company, and also intersect our philanthropic endeavors with our business alignment and our long-term strategy.
Byron?
Well, let me introduce Dynex really quick. We're a real estate investment trust, 30 years in existence, trading on the New York Stock Exchange. We're a small sector in the REIT world called mortgage REITs, which means our assets are basically loans against real estate or securities backed by loans against real estate. So the way we make money is by taking risk. And as such, our entire process is built around long-term strategic and risk planning. I've been in a position where I've had to articulate a long-term train of view, long-term thought process. And in that manner is the way I've really attracted the right type of capital to Dynex. By not being so large, and it's not our goal to be too large because then we have to take any capital that we could get. But by being a smaller to medium-sized company, we have the ability to share a vision, share a longer-term vision, which explains the type of risk that we're willing to take. We produce two products. One is our common stock, the other is our preferred stock. You buy our common stock, you're assuming probably some more book value and price volatility, but we're still going to pay you an above average dividend yield. We pay 12% today. You buy our preferred stock, you're probably under about an 8%, 7-8% type of dividend yield, but less price volatility.
Right.
And what I want to convince you as an investor is that we are in the same boat. I'm going to make money over the long term as a CEO because I own the stock and I continue to buy the stock. Part of my compensation each year comes from the dividend that most of my shareholders are looking to get. There is a growing population of older Americans, Asians, Europeans, huge growing demand for cash yield, not just earnings yield, but actual cash yield paid back to the shareholders. So I have to espouse a longer term view. 2015, we took a stance of de-risking our balance sheet. So we moved from the most risky assets to the least risky, highest quality, most liquid assets. When we started to talk this story and say that the world is more complex, surprises are highly probable, we look like the old crazy uncle in the corner on Thanksgiving. Now, we've stuck with that view, and now we don't have that issue, but we've had to sell it for multiple years. And even an equity analyst, who I don't think is necessarily, totally on our side, but he has agreed, you know what, you guys have been consistent. with your thought process. So as the CEO, I am the number one salesman at the company, and I have to sell that vision, and especially in terms of integrating strategic and risk thought process.
Christina, how does that play out for you at Dow Jones, which obviously is a company that has so many pieces to it?
Yeah, sure. So thanks. And you were with us at a point in time before my time. But so Dow Jones, we're a trusted information company. That's what we do. We do it on B2B and B2C. So we have brands like the Wall Street Journal, which I'm sure you all know, which has been around for 130 years. So hopefully it's not one of the five that we talked about. That would be a crying shame on my watch. But we have a portfolio of Barron's, Wall Street Journal, and then on the B2B side we have Factiva. We have products like risk and compliance products, which are speaking to the future, how you manage your risk, and so we are very future focused. We think about it every day. We are even compensated in that way. So we have to, because we have to meet the customer, whether it's a business, whether it's a company or a consumer, in how they're thinking in the future. As we think about ourselves, the way we consume media has changed dramatically over the last few years. You think about everyone used to read their print paper, now they're consuming all their media on their phones, and that's been a huge transformation. Podcasts are now just absolutely mainstream, and we have to be ahead of that. We have to be innovating products that actually meet and are actually leading those demands. We did a deal with Apple, which I'm sure you guys heard about, in their Apple News Plus product. And that's very forward-thinking. And our sister companies within News Corp just signed the deal as well in Australia and the UK. So these are the things that we're doing to stay ahead, to really really be the innovator in terms of media and as well as information. If we switch for a second back to B2B. Our largest growing product in Dow Jones is our risk and compliance subset, and what that is helping our corporates and banks stay ahead of regulatory compliance. So this used to be a back office problem. Now it's really very much front office and very much boardroom. So everyone's read in the paper about banks getting fined for various compliance issues. It's really bleeding into corporates. Also, with the advent of social media, concerning consumers are our new regulators. So we're really trying to be ahead there. So we're very, very much forward focused there.
But Byron, how has this process of forward thinking, future thinking, to a degree, changed how you are as a CEO of a company? And I mention that because we talk about the fact that obviously there's an investment component. People want to invest in the different properties. But the fact that the consumer in general, I think, is more forward thinking now, looking at a variety of these issues, I think plays a role here too.
I like the points you made, because that's what I was saying about me selling my ideas about global risk in the global environment. And the world's come to me on this issue. And I was the largest subprime investor in the world, actually, between 1997 and 2003, subprime securities. And I never bought another one after 2003. So again, back to people thinking I was the crazy uncle in the corner. And that's fine. And I've run public companies, I was running this portfolio, there's news articles, you can trace this. And so it's the idea of selling the idea and the vision, but then there's an element where I had to say, let me attract those investors who agree with me.
Right.
There are those who are not going to agree with me. And so let me attract those investors. There's also been another shift, which is the passive investor. So all of a sudden, 10 years ago, passive investors may have been 1% of my shareholders, now like 35 to almost 30-40%, with BlackRock, Vanguard being either the top 1, 2, or 3 investor of every company in my industry. So that's kind of changed things. One of the heads of one of these passive, and it's not one of the big names, said to me, Byron, we don't care about performance. And all of a sudden, I'm like, wow, that's a completely different metrics. They don't care about performance. Everyone will get their share of capital. So that's a long-term investor. So that's a change, right, that has taken place. At the end of the day, though, I've got to sell the vision. I've got to sell the idea. This is a risky environment. We have to do a lot of scenario planning.
You're listening to Knowledge Wharton, coming to you today from the Future Ready Conference in New York City, hosted by the Conference Board. Now back to our panel.
Arlene, how do you see that in philanthropy?
Well, I do think in the context of corporate philanthropy, that has substantially transitioned in this new world. And so from our perspective, it's not around sort of throwing money at sort of broader world problems that we all care about. But for us, it's more around being very strategic around how we can actually have impact. And so in the context of that, for instance, I'll give you one example of one of the pillars of our strategy, which is around economic empowerment and financial inclusion for small and growing businesses around the world, primarily owned by women and underserved communities. And when I went to the board of the foundation to talk about sort of we're going to shift and focus on this as one of our key initiatives, we sort of talked about how do we think about that in the context of alignment with the business. And what we talked about was the fact that we are, as we get ready for the future, we are also looking at expanding our audience of potential customers and are going down the risk curve as it relates to the size of companies. And my argument was we have to think about the fact that neither Google or Facebook existed 50 years ago. And if we were in a position to assist them in how they grew their business back when they were just starting off, think about the brand loyalty you would have today. Right. And so, you know, I also mentioned that we are looking at really emerging markets as the opportunity markets for us. And so we, from a philanthropic standpoint, want to intersect with our business strategy by helping to advance those businesses in emerging markets as soon as possible so they can ultimately become a part of our customer base. So that from our perspective is how you really intersect philanthropy with the corporate strategy.
Christina, you had told me the other day about the fact that being a future-ready, forward-thinking company for you also plays a role in human capital and how that moves forward as well.
Right. I mean, that's our biggest line item on our P&L, right? So, you know, people drive the business, and getting the right people around the room to solve problems and think ahead is absolutely critical, and that's our biggest investment, right? So when you think about you know, capital employment, it's in the people, right? The people build the technology, and so that's really important for us. Yeah. So
how then, using that word of technology here, how do you think technology is going to move this forward with future thinking and being future ready? How do you think that technology is going to continue to play a role in that, Byron?
I absolutely believe technology can help us make more efficient risk decisions. And I believe that our competition, or somewhere within the financial universe, that solution will be solved and will continually be adjusted over time. So the question we have is, being a small company with limited staff, how do we try to stay in contact with that development? So our strategy has been, well, JP Morgan is a large counterparty. How well can we partner with them to learn more about their technology? They have a bigger budget than we do. BlackRock, we've been a long-term customer of BlackRock. How can we partner with them or find out from BlackRock the technology? Or you say, you don't have to tell us your real secrets, but let us be involved as you develop the technology. We believe technology is definitively going to disrupt, and you can make better risk decisions. But we don't have the staff or the budget to really generate or do that research. So therefore, we are on a quest to build the right relationships so we can stay in the flow of information and development as it evolves.
Claire, how about you with the companies that you're involved with?
In relation to sort of technology and how it will disrupt things. I think the whole concept of patient capital is absolutely critical. So the sort of asset management firms that you get, like a Legal & General or someone who is a genuinely patient capital, is very important. And it was interesting in the panel discussion earlier, we were touching on how do you finance 5G? So in the UK, for example, there are people bidding to finance our 5G that are backed by Canadian pension funds, and they will put in a neutral host technology, and they'll get paid back over 20 years. And that's how it's going to be financed, the rolling of that out. So I think for technology to progress, we're really needed. All investors are not created equal. And will we actually see investors who are patient and who are ethical and who are creating funds for small businesses, diverse businesses, women-owned businesses? Will we see them having a competitive advantage in the future? Potentially so, because of their behavior. So I think there's some really interesting trends there. And I think all of our clients are really embracing this technology. But the key thing is nobody knows the answer yet. So having a vision about what the possibilities are and communicating that thinking loudly is what attracts the customers to you, so you can build a solution together. Because more and more now, one single organization can't build that on their own. It's all about the collaboration. And those partnerships between CEOs are becoming absolutely critical.
Christina?
So I think technology is already disrupting the way that we work and think and manage. And I think one of the big wins for technology is to solve the data crisis, because there's, everyone talks about using data for better decisions, creating value, things like that, both within things like risk, managing your risk, or figuring out, where to actually invest, or figuring out, and that's as a investor. Also inwardly as a CFO, where should we be investing? Use data to drive those decisions. And so technology just has really catapulted that into a very sophisticated experience for, I think, all stakeholders, and that's really important. And also, just on the commercial side, we talk about everything's a platform now, right? So we have really complicated solutions driving all parts of our life, whether you're, just watching television, whether you're streaming something, whether you're working on your computer, whether you're consuming, like I said, the media. It's all very different than it was just even 5 years ago.
Arlene?
I wanted to talk about the intersection of something Christina mentioned around the biggest investment is on human capital and the aspect of technology, and what that means in the context of being able to really attract talent in a way that changes the culture of the organization to be more receptive to really creative and innovative thinking. And so as we consider sort of being future ready, it's not necessarily just around sort of the use of technology today or what we even see, but really creating an environment where the talent that we're attracting is one that feels empowered to really be creative and innovative within a culture that may need to transition. And so from our perspective, that is as important as the consideration for the technological uses today, because we don't know what we don't know, right? And to some extent, when the presentation you made talked about the confidence that investors have in CEOs and their ability to make that shift, I think there is an onus on the leadership team and companies to also think about, what are we selling in regards to human capital, and how do we transition our culture into one where, particularly, I think we're all in sort of traditionally risk-averse types of industries. And so how do you transition that sort of culture to one that says, look, we need sort of more creative, out-of-the-box kind of thinking, and converge that with, the whole aspect of pipeline, which is a challenge, particularly in developed markets.
You're listening to the Future Ready Conference in New York City, hosted by the Conference Board, here on Knowledge at Wharton on Sirius XM 132. Now back to our panel.
Well, Christina, then I'll throw this to you, because in your industry with media that's obviously always changing and developing new aspects to it, and also the risk side of it as well, how does that change of mindset, that integration of technology impact the human capital, but also that philosophy of leadership, not only at the C-suite level, but down the chain a little bit as well?
Absolutely. So there's two things I think that are critical there. One is the leadership and forming a constituency that actually are problem solvers, right? Mm-hmm. So it's not about the technical knowledge; it's about their ability to, as leaders, and driving their people to solve problems. And the other is the customer. So you have to solve for the customer. What are you solving? Right. And so as an example, in our B2B business last year, we realized we wanted to solve the data conundrum for our clients. And so we formed like a think tank, right? We put people off campus. We got every element of our business from our business side to our data scientists to our finance people to our commercial guys and girls, and we put them off for like 6 months to solve this. And what they came back with was something that was very revolutionary for us, and we're going to commercialize that. And that's a new way of thinking, a new way of problem solving, and really, really fast forwarding to get ahead of the competition, to get ahead of risk as it happens, because risk evolves just as fast as everything else, especially with technology, and that's how we've chosen to do it.
I found it interesting, Claire, that the statistic that obviously a lot of people are talking about here is the 1 in 5 businesses being significantly impacted in the next 5 years. That alone, I think, is a wake-up call to a lot of organizations, to a lot of companies, that they need to change mindset in many cases.
Absolutely. I think the problem is that the burning platform isn't quite hot enough yet for people to make these really drastic choices, that they are going to transform their business model, and that's going to mean that they will not be returning returns to shareholders for a period of time, or they will need to burn through some capital. And I think what's quite interesting is capital allocation, and is it more difficult as a big, fantastic, high-performing, old-school dinosaur to attract capital than for one of the pre-profit companies to attract capital? And is there a sort of inequity between where the money is going at the moment, and are we seeing a bit of a market correction in that right now at the moment, in the last few weeks even? So I think that's really interesting. I think also what's really interesting is the fact that leaders don't think, the fact that investors think leaders aren't up to the job. And actually, what was quite interesting was we did some work to look at what qualities does this new uncertain environment require. And we found that actually the investors were pretty spot on, because when we profiled the leaders, we worked with Korn Ferry to look at the profiles of 150,000 global leaders. And when we looked at who would succeed in this environment, actually the stats for what the investors thought married up pretty much to the stats we had for how many leaders were like that in each market. So in the US, it's about 15% of leaders are what we'd call self-disruptive. And the problem is that organizations are very good at filtering out these disruptive people. They go off and become entrepreneurs like me or something. It's very hard for us to survive in a large global corporate.
That's very correct. Yeah. That is correct. And as a CEO, there's no job security. We have no job security. So over the last quarter or so, we cut our dividend. That is just sacrilegious, right? We cut our dividend. Our stock has taken a hit on it, and I'm continuing to sell the story. The interest rates in the United States, we have an inverted yield curve. It's not a normal environment, and it's a very vicious environment for a financial company. We believe we've been very disciplined, and it's a very much so a long-term decision. But in the short term, we're taking equity pain. And so I have no job security. I have to be able to convince investors to stick with Byron Boston as CEO of the company. But I'm used to it. I grew up an athlete. As an athlete, it's pure performance. Did you perform well enough today to perform in first place as a starter tomorrow? So I'm used to it, but I have no job security. It can be challenging. Some can handle that type of stress that others can't.
So then for you specifically in real estate investment, what is that long-term philosophy that you are selling to investors and potential investors?
Here's a couple of them. One, for the United States, there are an enormous amount of people that need to be housed. So most of Dynex's money over the 30 years has been through the U.S. housing finance system. So I'll give you an example. 10 years ago, close friend, one household, 4 people, 2 cars. Today, that household has shifted to 4 households, 4 cars. And the 4 households, the husband and wife got divorced. The 2 kids are already out of college, and they both have their own households. That's what's taking place in America, whether you recognize it or not. Today, baby boomers and their kids are all adults. there are an enormous amount of people that need to be housed. So from our perspective, there will be opportunities continuing to come to us for years into the future with this amount of people that needs to be housed. There's a affordable housing issue, so there's lots of problems to be solved. Yeah. And so we do have some data and demographics in which we can find opportunity to make money for our shareholders. However, we're in the middle of a very complex global environment. And I have to convince my creditors, my shareholders, because I borrow a lot of money. And so last night at the dinner, I brought a creditor with me. Somebody I borrowed a few $100 million. I brought him with me, and I wanted to talk about the long term. And I need to convince them, my creditors, investors, to stick with our vision. That one, we have our own money in the company, meaning the CEO and other senior managers, and that we've got the shareholders' interests at heart. But given the complex global environment, right, there's a lot of risk that may create volatility in the short term, but over the long term, you'll be okay.
Arlene, what's that message like for you with Moody's Foundation?
From our perspective, and you and I talked about this, that philanthropy philosophically tends to be sort of a long-term view. Yeah. I think that's true, but it is also, from our viewpoint, important that we think about the Moody's Foundation really as one of many assets that we used in regards to a longer-term strategy around our societal engagement. Right. When we think about that, we're looking for organizations that we can provide substantial impact, not just by writing a check, but also through aspects around our engagement of our employees, as well as the contribution of products and services that we have. And sometimes it's an opportunity for us to really sort of test the market, right? Because right. I mentioned we're thinking of, we have been going sort of downstream in terms of smaller companies. And so our strategy around small and growing businesses is even is part of the ecosystem of our customer base, but even further downstream. In the context of philanthropy, we think it's important to really align with the long-term strategy of the company. I talked about the key initiative around supporting small and growing businesses around the world, but we also have another focus on education. And we are looking at that in the context of really how do we help advance the development of a pipeline that would be helpful in terms of our execution of our own long-term strategy, including demonstrating to young people that it is, it's as I mentioned, over 100-year company. How do you transform the view of that, of us being sort of innovative and creative and receptive to millennial ideas? Right. And so we utilize our overarching philanthropic assets, I'll call them, to really relate that story.
We've got just a few minutes left, so we wanted to open up to questions from you out front. Okay, right here in front, if you wouldn't mind, you stand up and give your name and, yep, right here in the front. Oh, we have a microphone too, even better.
Hi, Katie Crichton with Prudential Financial. In a world focused on headlines, what's the most important thing for a company to do when communicating an action that doesn't make sense in the short term but is required for a long-term strategy?
You have to sell it. You have to create a clear, well thought out strategy. You have to start with principles on which you stand. So those principles will stay no matter what happens globally. So we have a risk principle, and we've been very consistent. I also, on our quarterly calls, I generally go back and say, this is what we said. Not to say, Nanny, I told you so, but it's more of simply to say we've been consistent. Because I want you to trust us, that we're not just running from one idea to another idea, that we actually have a set of principles by which we are approaching the world. As the world shifts and changes, around us, we're going to stick with the principles. So each quarterly call, I'm generally referring back to something that we've said to try to remind you that we have been consistent in our approach. But at the end of the day, I'm trying to get you to trust us. We're trying to get you to trust us with your money, and that whatever happens in the future, that we're imagining scenarios in the future that we can't see. We're imagining scenarios, which we did in 14, 15, and again, many people disagreed with us, and now they agree with us, and we're still in the exact same disciplined process to get there. So I'm trying to persuade you to believe us.
I think it's very long term. It shouldn't be a surprise. It should be an articulation of a strategy that you've been articulating for years, very consistently. It should have a name. You should be doing marketing around it. You should be doing major thought leadership pieces every quarter around it. And actually what we're seeing now is that marketing and thought leadership is feeding into the product. So, we're seeing people like State Street launch their diversity funds and Fearless Girl and that sort of thing. And you can see the consistency and the impact and the memorability of that kind of strategy. So I think bringing together the marketing and the sales, the product, and the CEO and the strategy all together as one is really key under one memorable banner.
And at the end of it, if you can go look at Dynex Capital, look at all of our quarterly presentations going back multiple years. The last slide in that presentation, don't look at the appendix. It's going to say managing for the long term, and it shows the performance of the stock since I've been at the company versus, I think it's a Russell 2000 because that's where we stand, and maybe the S&P 500 financials index. And we just want to remind you that we've managed for the long term. For a while, it was shaky. But now, as of 2019, 18, I've got investors saying, yeah, you guys have been talking about this long-term thing for a while. Investor relations is no longer a black box that sits in the corner. It's not like the senior analysts and portfolio managers we interviewed. It's the last thing they look at. Those quarterly calls are really important and your performance is important, but they look at everything around it. They look at all of your marketing. They look at all of your thought leadership materials. So I think there's almost the perception that this is customer facing and this is investor facing. That is not the case at all. Often your marketing materials are even more important because they're kind of decoding it. So they think they're sneaking up on you and they can see more truth in those than they can in the investor stuff.
Christina. Okay.
I actually think it is important to bring them along in the journey, but I don't think it has to be so orchestrated. I think it could be very authentic.
Yes.
And that I think is the key to trust and to inclusion is to be authentic.
Arlene?
That Christina.
Yeah. Sorry.
Made my point. No.
I'm authentically sorry.
Yeah.
Well, thank you very much for listening to us. Greatly appreciate it. Thank you to all the guests on the panel. Thank you very much.
For more insight from Knowledge at Wharton, please visit knowledge.wharton.upenn.edu.